Hey, I'm Kai, and welcome to Finance FI, Freedom and Independence. Here, freedom signifies the power of choices, while independence means not relying on anyone else financially to live the life you want. Join us as we explore budgeting, earning, saving, and investing to help you live your best life.
All right, let's dive into this. We're going to look past all the political headlines that you see everywhere, and instead, we're going to break down what a massive proposal like this could actually mean for the economy and for your money. And that quote really gets to the heart of it, doesn't it? This isn't just about politics. We're talking about a potential macro event, something with really big consequences for capital and for the markets. So for this explainer, that's our entire focus. We're going to put on the hat of a macro investor. Calm, strategic, looking ahead, and focusing completely on the economic chain reaction. First up, we'll explore why a broad tariff policy isn't just some minor adjustment. It's the kind of thing that has the potential to ripple out and touch everything, from inflation and interest rates all the way down to your own personal portfolio. Okay, next, let's get down to brass tacks and look at what's actually being proposed. We got to understand the mechanics of this thing before we can even begin to analyze the impact. What we're talking about here, consider this number. The U.S. imports over $3 trillion worth of goods every single year. A broad tariff hits that entire base. That is just a massive economic footprint. So the key thing to understand is that this is not some surgical, targeted policy. Nope, it's a systemic change. It acts like a huge, broad tax that would inject hundreds of billions of dollars in new costs straight into the economic system. And, well, that leads us to the most important question of all. So what happens when you introduce a cost of that magnitude into the economy? Well, in this section, we're going to trace the cascading effects, the economic shockwave that could ripple right through the entire system. This really is the multi-trillion-dollar question, isn't it? Do the foreign exporters just eat the cost? Do American companies absorb it into their margins? Or does it get passed on to you, the consumer? If you look at economic history, in most cases, these costs are passed directly through to the end consumer. How? In the form of higher prices. And that right there, that is the starting point for this entire macro shockwave. And this shows you exactly how the dominoes could fall. So first, the tariffs go into effect. That immediately raises input costs for businesses all across the country. If those businesses pass the costs on, then inflation, which we've been trying so hard to cool down, could fire right back up. And that puts the Federal Reserve in a really difficult position. It makes it a lot harder for them to cut interest rates. And when that whole soft landing story, the idea that the Fed can beat inflation without a recession, starts to look shaky, well, that's when you tend to see market volatility explode. This creates a fascinating tension, a real tug of war, especially in the bond market. On one side, you have fears of an economic slowdown from the tariffs, and that could pull bond yields down. But on the other side, you've got fears of inflation firing back up, and that could push those exact same yields right back up. This tug of war between two powerful forces, it's a classic recipe for uncertainty and, you guessed it, volatility. But here's the thing about major economic shifts. They don't just create risk. They also create whole new dynamics. So now, let's pivot and talk about where the money might actually flow in a new tariff environment. This right here, this is such a critical concept for any investor to really get. A big event like this doesn't just make capital vanish into thin air, it forces it to move. And so the goal is to figure out where it's moving from and where it might be flowing to. Now, what's so interesting here is how clearly this lays out the potential shifts. On one side of the ledger, you could see capital flowing towards domestic manufacturers. Think steel or cars, companies suddenly protected from foreign competition. Money might also start favoring countries like Mexico or Vietnam as businesses scramble for new supply chain alternatives. But on the other side, you have multinational corporations with these incredibly complex global supply chains, major exporters in things like agriculture and tech, and basically anyone who relies heavily on Chinese manufacturing. They could all be facing some serious headwinds. So, okay. Given all this potential change, all this volatility, how should you prepare? This last section isn't about trying to predict the future. It's about adopting a disciplined way of thinking about risk and opportunity. So the key is to focus on these fundamentals. In uncertain times, cash isn't a drag on your portfolio. It gives you flexibility. It gives you options. If there's a real risk of inflation coming back, long-term bonds get a lot riskier. That's what duration risk is all about. You'd want to focus on companies with rock-solid balance sheets that can handle cost shocks.
And you need to really understand if a company's money is coming from the US or from a global market that could get turned upside down. See, this is all about preparation, not panic.
And this is the perfect thought to end on. A big shift in trade policy would, without a doubt, bring volatility. But for someone who's prepared, volatility isn't the thing to be afraid of. It's just a changing environment with a new set of challenges and a new set of opportunities. The real enemy is being caught completely unprepared for the shift.